Alexis Meffre joins us now, Executive Chairman at Quilvest Capital Partners. Alexis, capital markets and some of the reports we're seeing around private equity suggest that this is not the market environment now for private equity. And CVC was one of the big ones we've been watching, whether it would go public, but now it's pulling that listing. What's taking place behind the scenes in private equity world around these big exits?
Well, I think, first of all, you have to watch the investors, what has been the investor sentiment for the past year. And as you may know, they have been hit by three factors. The first one is the well-known denominator effect, whereby they may find themselves overexposed to some asset classes and had to wait to rebalance their portfolio. The second one was a sort of cash crunch because they were receiving more capital calls and distribution from their alternative portfolio. And the third one was probably an arbitrage between private equity and fixed income or credit in general. So these three effects have actually made that year especially tough for the entire industry to fundraise. But we at Quilvest Capital Partners, we're more focused on the mid-cap, so it's quite humbling to go after Mark Owen, but we play in complete different space on the mid-cap, lower mid-cap space, where you do have seen more exits, more activity, because we're less dependable on credit to do deals, and we're less dependable on stock markets for our exits.
So as we try and get a gauge on how the sector is doing, I spoke to one big private equity player who said to me, look, this is not 2008 all over again, this is the 1990s. Would you agree with that assessment, that as we have to go further back in history to compare the sort of conditions we're seeing now for private equity?
Again, I will differ a little bit because I do think it affects differently whether you're playing on the large cap or on the mid-cap, low mid-cap space. I would say all crises are different, and definitely into 2008, 2009, you had a huge liquidity crisis. But today, again, we Quilvest, we're doing deals, we're doing exits, and I believe in our space, all the players are doing the same. So I do think it does affect quite a bit on the large cap space because as you've seen, there's practically very few IPOs coming up at the market at the moment. But in the 90s, the sector, I think, was a lot different. It was still at the very beginning of private equity. And now it's an extremely sophisticated market. We're extremely focused on sector, on size of deals, on geography. And for each and every crisis, the industry has responded and have up games in terms of skill set. So I think we're a lot better prepared now as private equity industry than probably we were for the tech crisis or for the 2008 crisis.
I think that's fascinating. But there's some trends, though, persist. And one is the fact that this industry has got $2.5 trillion of capital sitting there. I appreciate what you're saying about the differentiation between the small, medium and large, and indeed the different sectors as well. But in the round, it has $2.5 trillion of dry powder. And yet at the same time, people are saying it's too volatile to have exits on the equity market. And I've got to be honest with you, Alexis, I have zero sympathy for an industry that's saying it's too volatile on one hand, when surely volatility brings opportunities, and yet on the other side of the coin, it's not spending its money and it's just parking it at 5% 2-year paper. So, you know, the industry can't have all things that it's after.
I really think you're referring rather to the large cap. And I also think within your figures, we will have to look in detail, but it's probably the entire industry. But if you look at buyouts, so I think it's more about 2 years maybe on dry powder, or 2 years and a half, which is not tremendous. I mean, it's important, but not tremendous. But to your point, the prices have slightly come down, but on the lower end of the market, on the mid cap, you're still buying companies at a lot cheaper price than on the large cap.
So, OK, let's just focus in on exactly what you want to talk about rather than those large caps. We spent far too much time talking about the round as well. So where do you see the best opportunities?
Well, where we see the best opportunities is again, you have to think that private equity is not about macro. Obviously, we are influenced by macro, but it's about micro stories. So even in slow-growing economies, our job is to find businesses which are backed by secular trends. So in our buyout business, for instance, we manage $7 billion in private equity, private credit, and real estate. But in our buyout business, we focus mostly on business services and niche consumer. And we still see a lot of opportunity in what we call digital native brands. We still see a lot of opportunities in businesses where there's a tech light or tech enable factor, and which are backed whether in healthcare, whether in software, or whether in, I mean, that's the kind of service we'll be looking at, or education as well is something we're looking at.
Do you think that, you just mentioned healthcare, let's just go into one of those. Do you think the fact that Mr. Elkin is looking at this as well with his investment in Philips now. Now the whole industry going, oh crikey, we need to look at healthcare. We need to look at these digital areas. It's the opportunity in clear sight for everyone, and hence valuations have just gone up a little bit on that basis.
I think it's extremely tough to speak as healthcare as one and only sector. I mean,
but you talk about digital healthcare.
You really have to look at any subsegments, and healthcare. You really have to deep down and be extremely thematic and thoughtful and top down about what you're doing, because healthcare is different in each and every market, does answer to different regulation, and so, for instance, we invest both in the US and Europe, and the dynamics between US and Europe in healthcare are extremely different from one segment to another.
Yeah, I've got 20 seconds left then. Do you find that the IRA has actually changed the dynamic between the US and Europe in terms of investment opportunities?
I beg your pardon?
The IRA, the Inflation Reduction Act, has it changed the opportunities Europe versus US?
Well, no, I think you could find some, the US is a much deeper market, and so you would find tremendous opportunity in both geographies, provided that you are extremely focused on what you're doing and investing into the right sector.
Alexis, we have to leave it there. We've got the market open. Thank you. It's really an education, actually, and just telling us just how diverse the sector is. Thank you so much.
Thank you very
Alexis Meffre, who is the Executive Chairman of Quilvest Capital Partners.